like Satish mentioned, one thing to understand is, this asset class generates higher returns, but basic finance theory will always remind you that when returns are higher, the risk is also higher. And so that needs to be noted whenever you're looking at an asset class which is, delivering higher returns. It inherently, the underlying proposition is that it's a riskier asset class. Now, having said that, the value creation is right now limited, like you said, to either a certain size of ticket sizes, or people who have access to become LPs of funds, or people who have been doing angel investing, and it is still a smaller portion of the entire investing community. So what is happening with the advent of technology and so on is alternative investments are overlapping with fintech. And at that confluence, I think technology can play a role in getting wider set of people access to this kind of wealth creation. Second is companies themselves, the issuers themselves, companies that are creating this value are indirectly also democratizing this, because you are actually giving wider and wider set of employees to have access to ownership in the company. Finally, all this value is also created by employees contributing to it. And if you want people to think of as contributors, then you have to give some ownership in that entire project or that business, and that is happening through ESOP holders. And you would see that is another trend which is democratizing these. So in some sense, the wealth creation opportunity here is high, and companies are staying private. So essentially, if we go back to the proposition with which we started, venture capital, private equity that funds innovation. Innovation essentially means you're trying to kind of make something better or break something that exists and build it in a better way. And with that goes, that is in the category of, there is a certain amount of risk that is associated with it. But with the amount of private market capital that is accessible, local and global capital, companies are staying private for much longer. So essentially building some of these systems and rails to access the journey of a company from year 1 to year 12 or year 13 when the IPO happens is essentially how this problem is going to get solved, and greater number of people get access to this wealth creation opportunity.
So Mansi, kind of let me add additional perspectives. Completely agree with Ravi, and data shows that companies are staying private longer and raising a lot more capital. So when you really become a decacorn, the only option I feel left for you is to go public. There are very few companies, even they may have $500 billion or $1 trillion market cap, who end up buying companies for 30, 40, $50 billion, right, from balance sheet or issuing stock. So it's very clear that companies are staying private longer. Now let's look at not only from investors' perspective, we have the new investors, kind of accessing, this asset class, to generate returns or create wealth. Now let's look at the incumbent stakeholders. I think if you really look at, Ravi touched upon, the founders themselves and the employees, and then the existing investors. So what ends up happening is today, if you really look at it, 7 years ago, 10 years ago, the ESOP pools, that would be allocated when we invest in companies were smaller, and only limited number of people would get ESOPs, right? But that's not the case anymore. The pools are becoming larger, and it's very important instrument in attracting and retaining talent, right? What is in it for me? I also want to feel that I'm part of this company. I own a small piece of this company. And when this company is successful, I also benefit. I create wealth, which is equivalent to possibly 10 years of my savings of the salary, even if the salary is, is a good number, right? So for employees as well as investors, today, liquidity events only happen when there are new rounds that are happening. And so you have to wait sometimes, right? Somebody wants to, get a liquid or take off a small piece, right, from the table and obviously use it. They don't have an opportunity. So they have to wait for that next round. So not only for outside investors, how do they get access? I think even incumbents like employees and entrepreneurs and existing investors, let's say they were angel investors or Series A investors. Now you are in Series F. Right? Would you wait for another round? Company may not need cash at all, right? And they're generating profit. And so they may raise money much later, 2 years from now. So how do you get access to liquidity becomes a very, very important component.
That's so well articulated, Satish. So on one hand, you have people who have owners of the asset looking for some liquidity. On the other side, you have people who want to invest and get exposure to this asset class for the returns it produces, looking to participate, and therefore some amount of systems or technology to make those transactions happen will kind of make this market efficient.
Revolutionize your startup's equity management with Qapita. Request a demo today.